Patnaik, Director and Strategist for Religare Capital Markets. Titankar, good to have you back on ET Now. Thank you for joining us. Well, the big story today is the GDP data. Even though the GDP data is of immense importance for macro watchers, do you think from a market perspective it will do precious little, and irrespective of the GDP print, market needle may not move too much?
See, the CSO's advanced estimates were about 5% for FY13, which translated to about 4.8% for the fourth quarter. So therefore, unless the numbers are significantly lower than these levels, we do not expect the market to really react negatively, and very little probability that the numbers would be significantly better either. Our own numbers are marginally different. We are expecting about 4.9% for the entire year and about 4.6% for the fourth quarter.
Titankar, hi, morning. How does one approach the market?
Morning.
And more importantly, the auto pack, with the kind of turnaround that some of these companies have posted, you know, be it the likes of Tata Motors, M&M, all these stocks really holding out well. So how would you now place yourself when it comes to the auto pack?
See, I think autos have been a positive surprise. Pretty much analysts were writing it off as a washout quarter. That has clearly not happened. Numbers have been good across the board. You know, Maruti, there was some expectation that numbers would be good with the yen weakening, but numbers have been good everywhere. You know, Maruti has been great, Hero Motors, and then Tata Motors, then M&M. Everywhere numbers have been fairly good. The way we are playing it in our model portfolio is that we have an overweight. Our top picks in the auto space remain Tata Motors and M&M. M&M, our analyst has actually raised his target price from 1100 to about 1170 now on better margins, frankly. Tractors, frankly, are seeming to come around. The management's guidance of 6 to 8% has to be taken, with the best, it has to be taken positively. Our own estimate is around 7% volume growth in the tractor segment. Automotive segment also is likely to do fairly okay. So autos, we remain positive, Aisha.
But do you worry about market internals? The market breadth has been poor. Only 10-15 stocks are moving up. That's about it. Rest of the market is pretty stationary. Mid-cap stocks are lacking momentum, and there is a virtual breakdown in small-cap stocks.
Unfortunately, I have to agree with you there. We believe that the market's recent rise is not something of an India story. We have been pointing out that fairly clearly, that most emerging markets have actually moved up over the last couple. If you see from a longish period, last 2-3 years, Indian markets move has been actually trailing what's happening in emerging markets. A lot of the move has been happening by foreign investors. There is no domestic participation at the moment, as we well clearly know, and there the participation in the market becomes very clear, the composition also. So you have defensives actually outperforming cyclicals, which is why you have had quality ruling over beta at this point. To answer your question, is it time to look into beta right now? We say not. We maintain our preference for quality. Therefore, the market at this point does not seem to have a lot of legs left. We would advise profit booking at these levels because unless something fundamentally changes in the macro, we do not expect the rally to sort of continue purely on flows.
Titankar, what about pharma, considering the divergent moves that we've seen in that sector? You've got a Wockhardt and a Ranbaxy on one hand, which on account of the news flow have been so thrashed out, but on the other hand you have a Sun Pharma which has put on a whole lot and is now sitting at all-time highs.
We unfortunately do not cover the sector, so I will not be able to give an informed view there, but from our model portfolio perspective, and given that the sector is at defensive, we have kept a marginal overweight on pharma in our place, and Sun Pharma, Cadila, Dr. Reddy are stocks that we have in our model portfolio.
If I look at the history of Indian stock markets, in late 19s, consumers did very well. Similarly, in 1999-2000, IT stocks did very well. Between 2006 and 2008, it was engineering, capital goods and beta stocks which did very well. So historically, we've always seen that whenever the bull market starts, it always starts in a very polarized nature.
I wish I could agree. The only reason I will not is that I do not see much happening on the macro front. Auto numbers this side, as Aisha pointed out, have surprised on the positive side, but overall we remain fairly muted and negative on the macro. Global markets are moving on a liquidity fuel rally and India is no exception, frankly. Our GDP estimates for FY14 are at 5.8% with downside bias. So while I take your point that movement in the market has been polarized as we've seen earlier, it is also a reflection of what foreigners have been liking in India. They like the consumption story, they like quality. At the same time, they are not willing to go to taking risks in terms of infra, in terms of cyclicals, which we are calling the momentum stocks right now. So it is to me not very ambivalent that these cyclical stocks are making fresh lows at this point. It is but expected, and therefore, as I pointed out, I do not see the market sustaining these levels for long. You have to see a secular rally, and unfortunately the macro does not allow such a secular rally happening right now. In this case, the market is likely to remain polarized at this point, or people will be always willing to take profits at this point, which is why we are not comfortable with the market's rise in the near term.
Tirthankar, the series spelled out pretty bad for the entire PSU banking lot. In fact, the index itself lost about, almost 7%, and we've all seen what happened to SBI. Is there any recovery in sight for this pack?
See, we would not be advising going into PSU banks. We have been fairly negative on them, primarily because we do not believe asset quality issues are going to come down. We do not advocate having them as core portfolio holdings anyway. They can be trading bets depending on bank specific reasons. Sometimes PNB could do well, sometimes Bank of Baroda could do well or disappoint. A lot in these stocks in terms of performance has been depending on management commentary before the results. What kind of guidance do they see about asset quality going forward, and how restructuring numbers and NPL numbers actually come out. At this point, there is no reason we see to change that particular hypothesis. So from a model portfolio perspective, we would not advise going into PSU banks at this point, despite the fact that interest rates are going to come down over the next fiscal or so. We would like to play it through NBFCs. We like LIC housing. We can play even HDFC at this point, but not PSU banks.
But Tirthankar, at a time when the entire action is there in the consumer space, FMCG names, brand owners, what do you like within the consumer space where valuations are reasonable and there could be an upside potential of about 10 to 15% in next 1 year?
See, I wish there were many, but unfortunately there aren't too many stocks which have comfortable valuations right now. Most stocks in this sector have reached lifetime high valuations and continue to go up. That kind of trade is basically working out on that high liquidity that we are seeing coming in from foreign investors who like consumption in the country. One stock that we still like here is Britannia. We like Imami. These are two mid-cap stocks that we will still like in the consumption space. Page, of course, we discussed earlier that as you discussed earlier, is a stock that we would like at this space. Not something that will continuously go up, but from a long-term perspective we would buy. Another mid-cap that we would like, we don't cover it, but we would still like Zydus Wellness, another stock where we see 15-20% hikes coming in.
Let's get slightly more descriptive on Britannia and Imami, because both these stocks have done rather well in last 1 month. Britannia is up 17-18% in the month of May itself. What do you like about Britannia, and what is that appeals to you when it comes to Imami?
See, core thesis for Britannia, while I don't cover the stock specifically, is that margin improvement is likely to happen. Management has guided about 6.5% margins for FY14. Our analyst has kept about a 50 to 70 basis point margin hike. We believe that's going to surprise positively as input costs continue to come lower, and so these stocks would basically see their volume growth go up as they pass on part of the margin hike that they see back to the consumers. And overall, we are not really bothered about, we are not really worried about competition levels going up in the sector. All of these companies are looking at basically building up long-term niches in their own particular space, and therefore we would like Britannia from that perspective. And once volume growth kicks in, People will not see expensive valuations. Also from a TINA factor, basically there being a lack of alternatives in the market where there are quality mid caps who can actually deliver growth in such a weak markets. These stocks have an added appeal there. So Britannia and Imami we like from that particular space. Basically, to summarize, input costs coming down, volume growth going up.
Unilever, ITC, these were names which did very well the past series. In fact, the entire FMCG index held out. We just talked about Britannia, but Tirthankar, what's the call on ITC and Unilever?
See, Unilever, we do not see much event triggers basically going in forward. The buyback announcement was the last big one that we saw. So for Unilever, the core call over the next year is how much input costs basically come down and how much are they willing to. The same thesis that we applied on Britannica should work on HUVR as well. How much of a volume increase are we likely to see? So today the market is fairly happy with 5% volume growth. But if input costs actually come down further, then one could see volume growth surprise on the positive side to about 7% also. One other trigger that I would like to see is A&P spends have been fairly high for all these stocks over the last 2 quarters. One would expect A&P spends to not continue at those levels, and what kind of a negative does that come to, that put to overall pricing growth and sales growth is likely to be seen. So to us, at 580, 590 levels, HUVR is a stock that we would remain neutral on. We will not put it. In fact, in the model portfolio, we do not have HUVR. We have Dabur there instead, and we have ITC. Coming to ITC, this stock has basically benefited from being an index pick. Basically, for most large passive investors, it's a hugely liquid stock, and to that extent, we do not see much of an upside at this point thanks to its valuations, but we will not get out of it either. So, overall weight of about 9.5 to 9.7% in the Nifty, we are underweight on it because we can't keep such a high weight. We have about 5.5 to 6% at ITC in our model portfolio.
Tirthankar, what is your take on some of the OMC stroke E&P companies? In the near term, is there merit in buying some of these stocks because the big picture has changed? Subsidy burden will come down, crude prices have been supportive, so net FY14 will be a much better year than FY13.
I missed part of your question. Presume you're asking about downstream oil or energy space as a whole?
No, downstream and upstream both, because if subsidy burden comes down, downstream and upstream, both these companies will benefit.
See, our numbers are lower than last year. Last year's numbers of about 1.6 trillion rupees of under recoveries are likely to come down to about 1.1 trillion this year, and therefore we have a positive stance on most of these names, especially the stock that we like in this space is ONGC, frankly, because we believe that in addition to the drop in under recoveries and actually a very positive under recovery subsidy sharing formula that the government came out with last time a couple of days back, which was better than analyst expectations, we are also expecting gas prices to be revised upwards, and ONGC should see the kicker from both of these angles. From an EPS perspective, our estimate is about 30 rupees of EPS should go to about 39 rupees over FY14, and net realization thanks to the lower under recovery should go up from about $49 to $50 and to about $52 in FY14, FY15. So clearly we like ONGC in this space. Our new target price is about 390. So this is one stock that we really like. Coming to downstream, I think the better play right now would be BPCL. We don't really look at IOCL too much because of lower liquidity. HPCL is highly levered to any kind of petrol price hike or diesel price hike happening. But given that market has sort of taken them to be coming up on a steady basis, one would not see too much of a beta play in through HPCL right now. BPCL remains our favored pick in that space.
So two ideas from the house of Religare, ONGC and BPCL. Tirthankar, would you agree with my assessment that one should not ignore the weakness in Indian currency? Historically, those who ignored this kind of a correlation, they've only suffered.
Absolutely, Nikunj. I mean, completely. That's been our hypothesis forever, which is why one of the reasons why we are not so comfortable about the markets right now is because the currency has not really been playing in tandem. So, the rupee and the markets can diverge for short periods of time, but they have to go in tandem over the longish period. So, as you rightly pointed out, foreign investors, therefore, with a weak currency, have to get a double compensation, not just for the equity premium of investing in a country like India, but also what they lose on the local currency depreciation. So, unless we see rupee strongly improving or staying put at least, or at least getting some comfort levels, we will always see the markets open for profit booking at these levels, and which is why we will not be very comfortable with the markets rise. And I again completely agree that the current weakness in the rupee has more to do with what's happening in Japan than a localized macro feature. I don't think Indian economy is giving incrementally significantly negative news for the rupee to see the kind of weakness that it has seen. This is essentially a dollar strengthening trade. We believe 2013 would be a dollar strengthening trade, and which is essentially being helped by a US recovery thought and also what's happening in Japan.
Tirthankar, since you do seem a little bit cautious on the market right now, what's the range that you're betting on for, say, the next 1 month?
See, I will not be surprised if the market goes down to 5,850 levels at least. One would expect, at least until those levels, the market seems kind of overbought to me. See, the macro fundamentals are not very weak, as I pointed out earlier. We are not making significantly, incremental mistakes. We do not see politics as being a worry. We do not see any major macro trigger in the economy until at least the elections, unless we have a very bad monsoon. So, other than the monsoon and elections, there is no significantly negative, incremental negative for India. So, our long-term thesis remains positive, and which is why at some levels, around 5,800 levels, when the market comes back to a 10 to 15% discount to long-term averages, one would be comfortable buying. But what one would not do is buy into beta at this point, and until something happens on the currency, we'll be cautious on the markets.
Tirthankar, let's get some closing comments from you. Identify one high risk, high return idea for our viewers and one low risk, high return idea for our viewers.
Low risk, high return is fairly clear. I think ONGC or even GAIL, these are stocks that one would definitely like at this point. And on high risk, high return, Crompton Greaves is one stock that we have consistently pushed, and we'll continue to like the stock. It is a turnaround story. It's been taking a long time, but at 100 levels, 95 levels, there's not much to lose at this point. Our analyst has a target price of 160, so this is clearly a high risk, high return kind of story.
Right, Tirthankar, really appreciate your time and glad you could accommodate this interview request.